Ajay Tyagi, Head of Equities at UTA Asset Management Johnson, right now to talk about all of that and more. Ajay, great having you as always. Thanks for taking the time out. Good afternoon. And I hope all is well. Could it be, could this quarter be a tale of peculiarities in that, Ajay, that the delivery of numbers from companies might be skittish, but maybe the argument around what could happen in the quarters ahead might be constructive?
Entirely possible, and we've been living under this very hope for the last few quarters now. So yes, growth is elusive. If you strip off the growth on account of government spends or the government expenditure, what remains, which we also call as private consumption expenditure, PCE, has really been soft. So to that extent, I would say, yeah, there is hope. But what is also giving us hope is the fact that, look, any which way you slice and dice this entire equation, the end result is that in an economy where per capita income is growing at a very healthy rate, around 5.5%, and of course, per capita income still remaining at around $2,500, you can't see growth stall indefinitely. These are typically things that happen to countries which are in the middle income group when they reach about $9,000, $10,000 per capita. So yeah, why we are still living under hope is that the macroeconomic framework, the demographic framework is telling us that growth should revive at some stage. I won't be surprised if this quarter, once again, those hopes are dashed, but they will, live another day.
Okay. Ajay, we were talking to the India strategy team of JP Morgan, and they were of this belief that the markets could trade between 26,500 to 30,000. And one of their poll reasons was that the commentary pointing towards a recovery and a very strong earnings delivery in the second half is something that they sense. And they believe that at 24 times, it might not be too expensive, simply because, frankly, if you look at the math, the last 5 years, the average multiples have been 24. So we can always argue that the previous decade was 20, but the bull will argue that the last 5 years, the average multiple has been 24 times. So I argue about 24 times per se. The world is also trading expensive. What would you say to that?
No, here I would say I would disagree with this commentary. At least our view here is that markets are expensive. And there is no point looking at the multiples of a bull market. You have to look at multiples over a full cycle. And that's the reason why we very, very convincingly believe that this market may remain sideways, may not give any great return over the next couple of years. The excesses of valuations, which are more in the mid and small cap, clearly have to get washed out before we just move on to another phase, another strong phase of the market. So our view is very categorical there. We can't selectively look at bull market multiples and then make them as the baseline for through the cycle multiples forever.
Okay.
Also had a second part of your question, trying to draw a parallel with global markets. Look, here my answer to you would be two wrongs don't make a right. Just because US markets in particular are trading at very high multiples, you can justify India until this doesn't, remain to be the case. And therefore, very conveniently people start saying, okay, because US markets are correcting, therefore India is also correcting. So at least we don't play our game in a manner which is only trying to look at here and now. We always try to look at things from a longer term perspective, and that is just guiding us to the fact that let's be cautious, markets are expensive.
Okay, point taken, Mr. Tyagi. This is Harsh also joining in the conversation. So I wanted to take a leaf out of what you said, especially with regard to global, that doesn't look particularly enthusing. Where then and how then do you rationalize IT, both in terms of the numbers and the commentary that's coming through already, the initial commentary, as well as how valuations are stacking up for the space?
Sure, that's an interesting question, and this will have to break up into 2 or 3 parts. Number one, there certainly is going to be headwinds coming in for the sector, because we are seeing that, especially if, let's say, the tariffs don't get rolled back, and Mr. Trump this time finally puts those tariffs as he has announced in the last week or so, starting 1st of August, then obviously it's not good news. It will lead to global growth slowing down, growth in US slowing down predominantly because of inflation, and growth in other countries also slowing down because obviously their exports don't remain as compared. So there's going to be downstream impact on growth. That's not good news for IT globally. The other thing which is happening is, and that's something which we've been hearing from many companies, that look, last 2 3 years growth has been strong, particularly in the US, and yet IT spends have been weak. Many IT chiefs are now coming back and saying we can't hold on to these IT budgets forever. We have to go out and spend, because IT is one big source of productivity improvement, which has always led to the US companies and the US corporates remaining very strong and actually becoming more and more competitive by the day. So that's the other view, which is that you can't keep pushing, kicking the can down the road in terms of these IT budgets. Now, sum total of this is that, at least our view, that larger companies in the IT sector will find it very difficult to grow at low double digits that most people are expecting them to grow. So we will have to now accept the fact that structurally many large IT companies may not be able to grow at 10, 12, 13%, possibly mid to high single digits. And that's something which may lead to reset of multiples. So we'll see how that happens. Equally, I would say that there have been some very, very strong mid-tier IT companies which have shown the ability to win deals even in a weak environment, actually increase their market share. And while people used to talk about vendor consolidation, possibly benefiting the larger IT companies, but that hasn't panned out, at least in the last 3 4 years, because the mid-tier companies have actually been able to win these deals while this narrative around vendor consolidation was still going strong, and they've been actually able to show much, much better growth. So yeah, you'll have to be very selective in IT, and obviously, think about all these issues that I just said a while back. Yeah.
Super candid, sir. So the other piece you spoke about is how India consumption remains intact overall. So how do you play that? Because there are just now, there are just so many ways to play it now. You've got QSR companies, and now you've got the new age tech giants, Eternal, Zomato, all of those that have also come through. All of those are a play on consumption, and then you have the traditional avenue supermarts and the like. Without taking names, and I understand where you come from, but give us a perspective of how you play it, therefore.
So I'll just give you a big picture view. That's something which I and all my other colleagues here at UTI keep discussing. I think what's going to happen going forward is that the consumer wallet is going to turn more and more towards discretionary items. So we've seen between 1990s to, let's say, mid of 2010. So let's say 1990 to 2015, consumer staple companies had a dream run. They actually continued to show very strong growth, ever increasing margins. If margins weren't increasing, at least they were very, very stable, increasing string of cash flows and so on. So they were, really rewarded. Of course, they showed earnings growth, but they also actually, over this phase, saw accretion to their multiples. What's happening right now, at least that's what we are observing, is that the penetration of many of these staples categories has become so high that it's difficult to imagine a double-digit growth from these staple companies. So they may remain a high single-digit kind of growth company or companies, but the consumer is wanting to try more and more discretionary things. For instance, QSR. For instance, going out and buying jewelry. For instance, trying different formats in retail. For instance, spending more on apparel. So with increasing per capita income, while staples consumption doesn't increase that much, but discretionary consumption does increase. So therefore, some of the names that you took coming in from QSRs or retailers, to my mind, could be exciting spaces in the coming decade, because that's where the spend is going to be. That's where the disposable income of the consumer is going to be spent.
Okay, Mr. Tyagi, been a pleasure getting that perspective in. Thank you so much for joining us this afternoon, giving us all of that viewpoint.